Morning, everyone, and thank you very much for joining me. This is the morning market review. It's Friday, the 22nd of April. My name is Russell Shaw. I'm a senior market specialist at FXCM, and of course, my email address rshaw@fxcm.com. And I encourage you to send me emails if you need to communicate with me during the day. Just bringing up a high risk investment warning. I'll keep this on screen for a few moments. And here's our market commentaries disclaimer. And just finally, our references. I want to refer to the 10-year to start off with, but let's start off with the CNBC, and then we'll get to the US 10-year. The CNBC morning article reads, European markets set to fall as investors digest Powell's comments. And it reads as follows: European stocks are expected to fall on the open after Federal Reserve Chairman Jerome Powell said a 0.5 percentage point hike is on the table for next month. Okay, I think the market knew that. So I guess just a little bit of extra confirmation there. It comes after a dramatic reversal in stock markets in the US Thursday, with major averages closing low, wiping out earlier gains. So the reversal was vicious. It actually looked as if the American markets were well and truly on their way up. But of course, the comments really turned it around. Earlier in the day, Federal Reserve Chair Jerome Powell commented on the possibility of a larger than usual rate hike next month, spooky markets. Speaking during an International Monetary Fund panel moderated by CNBC's Sarah Eisen, Powell said taming inflation is absolutely essential. I would say 50 basis points will be on the table for the May meeting, he added. US Treasury yields also jumped on the back of Powell's comments. The yield on the benchmark 10-year, which started the year near 1.5, last stood at 2.955. We've got it coming back at 2.91 and or closer to 2.98. And back in Europe, French voters are heading to the polls Sunday in an election that will decide the next president. The second and final round of the election puts incumbent Emmanuel Macron against anti-immigrant party leader Marine Le Pen. In a note Thursday, Goldman Sachs described the elections as a decisive moment for France's policy path. If Mr. Macron is re-elected, we would expect him to revive his reformist agenda as a continuation of his pro-integration plan for Europe, the analysts said. These reforms are to a large extent embedded in our current forecast. Should Marine Le Pen be elected, we would expect an institutional impasse owing to the likely lack of a parliamentary majority in next June's legislative elections and significant friction with EU partners. SAP released earnings Friday, flagging a hit to its revenue from its exit from Russia. The German software giant said its decision to leave Russia following its invasion of Ukraine was expected to lead to a negative revenue impact of around 300 million euros. Revenue growth at the company surprised to the upside, however, coming in at 11% for the first quarter. All right. So how do we consider yesterday's movement? Let's actually take a look. I'm going to come back to the US 10-year. I think it's integral to the analysis. Let's go through to the Dow. And here's where you can see it really started coming down. Okay, if you take a look at this on the daily chart over here, it was looking really quite comfortable in zone 1. Look at this big selling tail. So it reached a high yesterday before really succumbing to, I guess, the bears. And now we've gone back into the neutral. So a big negative move yesterday. Just going to move aside. All right, so To me, definitely something that was unexpected. Nevertheless, let's go back to the US 10-year here. Hey, Howard, morning to you. Nice to have you on the webinar. Let's just go back to the 10-year. This is really overbought. The yield is, if we take a look at this as a technical pattern, it will look as follows. Okay, that's the pattern. Can you guys see it? Left shoulder here. That was weird. Look first, then leap. That was weird. All right. Left shoulder. Okay. Then we've got a head over here. And then we've got a right shoulder here. All right, then it breaks out. Here's the pullback. So it's pretty much textbook until this part over here. I wonder why it's coming up with this look first then leave. That's really weird. All right, pullback. And that's kind of very textbook. And then what we'll do is we'll put in a measured move. Now, the measured move in of itself is it's fraught with controversy because sometimes they're more academic than anything, in my opinion. But in this case, I would just put it in. There's the breakout. So you can see we're kind of hitting the measured move here. And tell you something that's weird about these measured moves. The articles that seem to get that are the most popular is when you put a target in. Okay, so those tend to be the most sort of traffic generating articles. Nevertheless, you can see that so we've run about 3% in terms of target and this breakout. Let's maybe make it a little bit. All right, so that's the measured move. Now, in technicals, of course, the measured move, they say, is the minimum target. But to reach it so quickly, we've got 7 weeks, 1, 2, 3, 4, 5, 6, 7 weeks of adjustment in the yield. So in terms of the speed and the magnitude, look where it's put our RSI. It's put our RSI close to 90. Okay, the RSI for me, the most useful part of the RSI for me is that it's fairly accurate in my experience in terms of extremes. That's about it. You can maybe use 50 as a dividing line between bears and bulls. I've never found a real use for any divergences or anything like that. It's really the extreme. So we're extreme here, right? So you can see that the RSI being overbought would need to correct theoretically. Okay, so we can, last time corrected here, over here. It kind of here's sort of 2 weeks and then it was back up. Here's an extreme to the downside. Okay. There's an extreme to the downside, etc., etc., etc. Now, clearly, we're overbought. Now, the way that I tend to look at the RSI is kind of in terms of the Pareto principle, 80-20. 20% of the time it's extreme, 80% of the time it's between 20 and 80. So I am of the opinion that there has to be some sort of either slowdown in the speed of appreciation of the yield, maybe some sort of pullback, just as the RSI normalizes. Now, I'm not calling, I want to be very clear here, I'm not calling for lower yields ahead. I don't believe that at all. I think we are in a uptrend for yields. Clearly that central banks are extremely hawkish. We know that there's quantitative tightening, we're about to embark on that. The trajectory, the path for yields seems to be higher, but we also know that price doesn't move in a straight line. What's the price of money? It's interest, it's yields. And you can see that on the way down during QE, it zigzagged, okay. On the way up, it tends to zigzag. So we've kind of got the zig, right? We're now waiting for the zag. The problem here is, of course, we are in a very uncertain environment. Yesterday, when we took a look at our chart, we were in the neutral area by and large. Uncertainty, right? You're neutral, you're uncertain. There's no catalyst for higher or lower prices. And that means, I think, market participants are on edge. They're looking for that catalyst. So when Jerome Powell says we are looking for a 50 basis point hike, it causes some sort of movement. Truth be told, we all expect a 50 basis point hike in May. We've been saying that for a few weeks now. So what's changed? I'm not sure anything has really changed. We know that the central bank is exceptionally hawkish. We know that they are looking to tame inflation at all costs. And when I say all costs, the cost is going to come to the labour market. They just of the opinion that the labour market is resilient enough, robust enough to withstand the higher rates, and they're hoping for a softer landing. That's a gamble, but that's what they're hoping for. So the likelihood of rates running higher over the long term, I think, are good. The rates of running hot over the short term, I feel, are less favorable. I think there has to be some sort of moderation here. That moderation may be a pullback. It may be a pullback, or it just might be a stabilization. We might just see some sort of consolidation around the 2.9% before the next leg up. So what's the whole point of that? Well, the fact of the matter is, if there is some sort of moderation in yield, and if there is a pullback, the pullback probably would be shallow. I think would be the greatest probability. So let's call it sort of a moderation. The 7 weeks of rapid increase is probably near its apex, right? So that being the case, I think the focus of market participants is going to switch to earnings. Okay, earnings become the catalyst as opposed to monetary policy, because nothing's really changed on the monetary policy side. The fact that Jerome Powell has called in for a 50 basis point hike, okay, clearly it has some weight, but it's nothing unexpected. So the idea here is, if there is a shift in focus to earnings, okay, and if there is a moderation in yields, well, then the dips here become extremely interesting, because it may be a short-term buy the dip scenario. So the pullback yesterday, whilst surprising, okay, is something that we should be looking at with interest, because there is a really the earnings actually haven't been bad. In fact, they've been good, besides Netflix. Okay, Netflix was awful. Okay, but then we had a nice Tesla surprise. Banks weren't great, but most of the earnings so far released have been beating forecast. Okay, in that type of environment, if there is a shift towards earnings, and especially good earnings, okay, then these dips in the near term become interesting. I still think there's headwinds for the market. The headwinds for the market aren't going away. It's just, I think we're in a unique, let's not call it unique, let's just say we're in a situation now when it seems to me the yields need to moderate. It comes at a time when we're having earnings season for Q1. It's a good mix. That seems to be a good recipe for looking for potential dips. That being the case, okay, we can go down to the hourly chart and we can start measuring to see if those dips are going to yield anything. So is there going to be a crossover here? Is there going to be a crossover here? Clearly there has to be some sort of signals, some sort of triggers. And even once we get those triggers, they're not complete without the stochastic showing us that there's an underlying momentum, right? So the underlying momentum is everything. Okay? The crossover signals, they just triggers. They don't mean anything until we get the momentum. The momentum is everything. Here sticks in the upper quintile. There's the move. There's the swing. There's the swing. Okay, but these dips now become exceptionally interesting for the immediate term. For the immediate term. Okay. Okay, so Rob says, where's the best place to get a Fed rate monitor? So the one that I think is most accessible, let me see if I can bring it up again. This wasn't part of my sources page, so I just want to emphasize where I'm getting this from. And I'll show you in a moment, Rob. It's in my favorites. I just need to bring it up. One moment. Okay, it's just taking quite a while to load. I'll show you as soon as it comes up here. Here it comes. Okay, cool. So I just use the CME groups tool. Okay. So CME group, you can just do a Google search for it. It's the CME Fed Watch tool. 12 days left, okay, to the next FOMC meeting. It's really cool. 100% sort of, so it's close to 99.8% that, wait a second. Yeah, okay, so yeah, this is the target rate. So the current target is 25.50. So we're going to add 50 basis points, will bring us to the 75.100. And then what you can do is, Rob, you can go through to June and see what the probabilities are. And you can see that there's an 80% chance, the market's seeing an 80% chance of another 50 basis points in June. So that's the tool I suggest. I haven't used the investing.com. Does that answer your question? So 100% chance between 75 and 1. Now, what they're saying there, Rob, when you're looking at 75 and 1, just make sure you are reading it correctly, because I'm going to just go back to May. Okay, where are we right now? We're at 25 to 50. Okay, that's the current target, depending on what if we're looking at the Fed funds rate, etc., slightly different interest associated. So this is their range. If they tack 50 on, that's where we're getting the 75, 100. Doesn't mean we're getting 75 to 100. Okay, all right. So it's that XCA, exactly. So we're looking for a 50 basis point hike, correct? Okay. All right, let's just bring this up here. All right, so the markets, the cash markets opened in Germany. We'll go look there now. So we just want to see if these dips provide signals. The signals in of themselves, don't mean anything without the momentum, right? So we just go through to the DAX. All right, so you can see the DAX here, looking for a potential crossover. So we'll keep an eye on that, okay? Crossover 1, remember it's a dual crossover system. We've already got the first crossover. It means nothing without the momentum, okay? And we don't know if we'll get the momentum, and that's exactly what trading is all about. That's why you have stop losses. That's why you have risk management. But if we can get some sort of movement into that 80 area, that's the momentum we're looking for. Now, I tried to trade euro yesterday. I went short in it, I got stopped. Okay, so I got stopped here, which was a bit of a pity. So saw this. I saw that we had these sort of this rally in the downtrend. Tried to take advantage of that over here, and bang, got stopped out. So that was pity. So that was just my trade yesterday. I just wanted to show you guys, and then I want to just also highlight the US dollar. US dollar is again, I think, bullish, but if we do get that pullback, if we do get that moderation in yield, there might be a moderation in the US dollar. There might be a moderation, and again, I would call that sort of temporary, right? Because the environment is a tightening environment. So just go back to the euro, because there is a complexity that's been introduced here into the euro. And what's that complexity? Well, the complexity is, right, that there has been some comments from two governing council members about the first one was about raising rates in July. Now that surprised the market, because last week's press conference, President Lagarde communicated they're going to finish the asset purchases program in the third quarter. Only when that APP was done, they would start looking to raise rates. And then, of course, the second comment was also hawkish, which I think was by the vice president of the ECB, a chap by the name of just escapes me at the moment, I beg your pardon. But the idea is, he said, well, there's no reason why APP can't end sooner. So we had this big spike up, boom, that hit the stop loss. It's subsequently faded, okay, and I guess that happens in markets. But what I would suggest is that if the ECB is starting to swivel hawkish at a time when dollar may be moderating, I just want to suggest caution, because the euro has been actually a terrific pair to be trading. Okay, it's really been moving really nicely once it hits the zone 3. So just understand there is now a bit of variance coming in on that side as well. So very interesting times for us in the markets. As always, the only real insurance, so to speak, that we have is stop losses and risk management. So don't neglect that. All right. If there's any questions, please go ahead and type those in. Any questions, please go ahead and type those in. Okay, excellent. Have a terrific weekend, guys, and catch you on Monday. And have a good day ahead. Thanks, everyone. Strange markets indeed, Howard. Very tricky, very tricky.